Let's bring in one. Fifth Third CEO Tim Spence joins us from Cincinnati, Ohio. Tim, it's great of you to join us on a day like today, where we are seeing pressure on the entire group, including your stock. What are you hearing?
Yeah, no, thank you, Sarah. I think days like today are the days where it's most important for us to be out in front of the markets and in front of our clients, just to reassure them that the issues, as you mentioned earlier, as Carl just mentioned, really are contained to a limited number of banks who either had concentration challenges in individual sectors or asset liability mismatches that are now working their way through the system.
Do you have any of those?
No. I'm exceptionally comfortable with the position that we've got. We have one of the most granular, stable deposit bases among any of the regional banks. A significant share of our deposits come from individuals. And I was talking with our folks in the branches and the call centers as recently as this morning, and there's no unusual activity going on out there at the moment. We carry our securities portfolio 100% available for sale. So this issue that materialized in Silicon Valley, where held to maturity was really hide to maturity, is not a problem that we face. And we have the ability to access contingent funding through a wide variety of sources above and beyond just having a strong deposit base.
Okay, so just want to be clear, because there's a lot of talk, Tim, and concern out there about uninsured deposits leaving the industry. You're not seeing anything like that happen right now at Fifth Third?
No, we're probably not the best litmus test for you, because such a significant share of our deposits do come from consumers, from our consumer business. But we're not seeing anything out of the ordinary here in terms of the flows of funds. That said, for the industry in general, it's probably too early to tell, right?
One thing we got this morning from Schwab in their release was this percentage of total bank deposits that do fall within the FDIC insurance limits. Can you give us a similar number?
We run slightly ahead of the regional bank average in the low 50s.
In the low 50s. Are you bracing for a new era of regulation, a hotter spotlight, once we sort this out and we start looking at remedies to prevent a similar episode in the future?
Oh, I think there's no question that there will be a policy response here. We have been anticipating for the better part of the past year that TLAC may make its way down into the regional bank group, so we're very well positioned in that regard. I also think at some point here we have to address the accounting designations and the differences in the available for sale versus held to maturity treatments, because there's no question that what triggered the outflows at Silicon Valley last week was the surprise on the unrealized losses on their securities portfolio, because such a significant share of it was embedded in held to maturity securities. And at least in our case, well more than 99% of our securities are in the available for sale book. So it's very clear to investors where we stand. I feel very good about that.
What is the financial health? How would you characterize it of your commercial and consumer customers right now?
I mean, it continues to be very strong. We talked about this as recently as this past Wednesday at the RBC conference. Business health is very, very good. Consumers, in particular homeowners, have been able to manage inflation very well. I do anticipate with the noise that's in the market that you're going to see people be a little bit more reticent to make large investments, at least until they have confidence that the issues that we're seeing play out here are contained in either the tech focused or the crypto-focused banks. But in general, the health of the consumer, health of commercial clients remains very good.
That's what I was going to follow up and ask, which is how these recent events will ultimately impact loan demand and credit quality.
Yeah, I think in the immediate term, I would expect that the loan demand will continue to soften. But that had been happening over the course of the past few quarters in general, just as businesses look forward to the impact of higher rates on the economy.
One of the things the street's wrestling with right now is separate from the, from the events of the weekend and this crisis, in a sense, is the model changing. How do you keep depositors from just being attracted to other instruments like money markets? Do you have to raise your rates? Do you have to offer better product? Do you have to lower your fees? How is that going to work if the delta between what you get outside and what you get in the bank is so different.
Yeah. No, Carl, I'm glad you asked that because I think this is an area that's probably not as well understood as it should be. The stability in your deposit base is really a function of the share of your deposits that are operational to your clients, right? So for the average American household, it's the account that they pay the mortgage or their rent out of. It's how they buy groceries. It's where they get their paycheck. For a commercial client, it's where they manage receivables and payables. And how they handle short-term liquidity needs. So the focus, I think, really has to be on the quality of the product offering and the degree to which you're doing things, whether that is on the consumer side, giving somebody your paycheck early, helping them to manage unexpected expenses, and right. Giving them tools to avoid fees that really drives the stickiness and the stability of the deposit base. And equivalently, on the commercial side of the equation, it really is the value that you can build into the management of the accounts payable, accounts receivable process. So that has been our focus, right? And I think you have those good core operational deposits. Rate paid is less important in that particular portfolio, and it allows you then to use the rate that you do want to extend to manage your overall liquidity profile.